So the other day, I revealed my process and playbook for actually investing into DeFi liquidity pools, all the way from the process of blueprinting and just planning out the portfolio to starting to find strategies using metrics finance and validate those positions and then actually deploy those positions. Now, today, I'm going to be going over the second half of that, which is what you do after you deploy your capital, how you manage these positions, how you track performance, how you optimize for long-term growth, and of course, how you can make sure that you reach your long-term goals. So we're going to dive right into it in today's video. Here's one of the positions that I currently have opened. It is Ethereum to syrup. This is a pretty solid position right now. It's doing a 128% APR. Now, one thing I want to go ahead and point out here right at the beginning of this video is APR is not the most important metric. It's very important to keep that in mind. Just because a position is doing a good APR does not mean that the position is doing good. You can have positions that have high APRs, but ultimately it would be better holding Bitcoin or Ethereum or both of these assets outside of a liquidity pool as opposed to being in a liquidity pool. Now that right there is the opportunity cost or the divergence loss. So if we open up this position on Metrics Finance, which for some of this data, you will need a pro subscription. Once again, there is a free trial that you guys can open up if you guys do just want to try this out. But under divergence loss, we want to pay attention to this initial asset section first. This is saying, hey, Jake, you put 52% of your $10,393 deposit in Ethereum, and then you put 48% of it in syrup when you entered into this liquidity pool. So it takes those ratios, those numbers right there, and it says, hey, Jake, if you took your $10,393 and you held it in those ratios as opposed to entering in the liquidity pool, to date, you would have $9,853. But since you're in this liquidity pool, you have $9,718, which means that you have $135 less by being in this liquidity pool. But Jake, you also have some earnings. You have $419 in earnings from fees by being in this liquidity pool, which means that you are profiting $284 compared to just holding in a 52-48 ratio. It also says, hey, if you held in a 50-50, you have a $263 profit there. If you just stuck all your money in ETH, Jake, you are beating that strategy by $916. And if you were to just stick it all in syrup, you would actually have $309 more than what you have in the liquidity pool. So that's kind of how to comprehend these specific metrics right here. These are the important metrics that we look at. And another important thing that we look at is the actual profit margin on your yield. So for example, if you have $419 in yield and then a $285 profit versus hodl, you can divide that profit versus hodl by your yield. And that's going to give you a profit margin on your yield. That basically says you are keeping 67.7% of your yield. The other 33% roughly is going towards divergence loss and paying that down. Now, there are instances where your versus hodl can be in the red. It can be negative, and that's not a good sign. That means that you might be doing a high APR. We've seen clients doing 400% or 500% APR, but then they have a loss compared to hodling in the market, and it's not a fun scenario. Now, if you guys want to make sure that that's not you, I do have a full video breaking down my exact strategy for building positions just like that. I'm going to leave it in the cards right now, but also right below this video, I'm going to leave it linked as well. And while you're at it, make sure to drop a like and subscribe notifications turned on so you don't miss out on the content that I put out every single week. The divergence loss is just something that I wanted to point out right at the start. Another consideration when it comes to rebalancing is where you're at in your range. We always want to rebalance before we go out of range because we have lower divergence loss when we do that. Now, we have something called SMART, which is what we use for rebalancing. It's called the SMART framework, and it's for smart rebalancing, basically. Now, when we rebalance, there's a couple things that we can do. Number one, we can add capital instead of swapping assets. And that's going to allow us to finalize no divergence loss. We still have the divergence loss, but it's not finalized. We can recoup that money basically. And if you guys are unsure of what rebalancing is, it's the process of basically exiting this position right here that has a range of maybe, in this instance, 4,500 to about 8,500 or so, and then going and choosing a different range and entering into a new position. So rebalancing is taking the money from this, executing a trade, getting to the right ratio, and then putting it into a brand new position. But what I'm saying is if you add capital, then you can rebalance with $0 in divergence loss. Now, on top of that, the best time to rebalance is at your initial entry price. But again, you're not always going to get to your initial entry price or be there. We understand that because assets move. And this price right here is determined by both of the assets' prices. So when we take a look at this right over here, syrup per ETH, you could see that we started at an initial entry price of roughly 6,000 or so. And it creeped all the way down to roughly 4,700 or so. This period is where we would have had the most divergence loss. And now it's kind of creeped back up basically. It's all the way over here at about 55.81. Now I'm at a point where I'm profiting compared to hodling the market at a roughly 70% ratio. It's not amazing, but it's good. And on top of that, We have previous data showing that the price can go down here. And if we look at the current trend, it looks like it could flip and start to go back down, which means that I need to rebalance this pool now at a point where I don't have a lot of divergence loss, and I need to cut out some of the top part of this range because we are not hitting those parts. We are going towards the bottom of this range, nearly going out of range. So it doesn't make sense to have this much room right here when we could add it on this side right over here. So that's another consideration that we look at when rebalancing. So when I'm diving into this Ethereum to syrup pool, what I might do is adjust this max price just a little bit, bring this down and cut out some of that fat. We're basically wanting to trim the fat right here. So we put a $7,500 max price, and then from there we can start to adjust our min price as well to something along the lines of maybe 4,000. That's going to give us a little bit more room. But even then, that's putting us back at about 46% syrup. We started about 48% syrup. And considering that the price is going down, that tells us that syrup is doing better than Ethereum. So if we want to account for that trend, we want more syrup because we started with 48%. Now we have 28%. And in these liquidity pools here, people are buying the higher performing asset, which is why it's the higher performer basically. So in this instance, people are buying our syrup, it outperforms Ethereum, and ultimately they are giving us Ethereum in return basically. So we wouldn't want to start with say 46% in this instance if it's very clear that syrup is doing better than Ethereum. We'd want to adjust this min price to maybe something along the lines of 3,500, and that's going to get us roughly 55% syrup and about 45% Ethereum. And that's a much more reasonable range. And ultimately, that's going to allow us to continue to collect on this consistent volume of about $1 million per day. But at the same exact time, make sure that we don't go out of range and we don't have a ton of divergence loss. Now, similar to what we did in the first video, we always want to revalidate strategies when rebalancing them. Even if we were just in a strategy or a position for a long period of time, maybe performance has started to decay or things have started to switch up, we want to revalidate that. And we do that by looking at the actual risk-adjusted return of this position. So in this instance, let's just say this position is doing about 120% per year or so. We're wondering, are these high-quality assets? Do they have strong correlation? They have consistent trading volume, adequate TVL, healthy fee to TVL ratio, favorable divergence loss recovery, manageable volatility, optimal liquidity distribution. Is this a battle-tested protocol? Do they have a sustainable APR range? And as we start to check off more of these boxes, the risk-adjusted return starts to get better for this position. And we're looking for consistent risk-adjusted returns, something that has a consistent risk-adjusted return that isn't constantly changing, that isn't all over the place. All of that is taken into account, number one, before we even enter the strategy, but number two, after we enter the strategy, we are continuously reassessing. Now, guys, in our DeFi formula, we walk through exactly how you can fill all of these out with AI. And if you want to learn more about our DeFi formula process, I have a YouTube video breaking it all down and exactly how you can do that right below this one. But that's revalidating the position. Now, let's just say we have a couple different positions over here. They're doing well, and we also have some allocations towards hodls and stuff along those lines. It's time to create our flywheel. And our flywheel is basically, where's our income going? So for example, let's just say I do only have this Ethereum to syrup position. I have to determine, okay, well, off of the $1,000 that this position is making per month, where's that going, right? How much is going to liquidity pools? How much is going to lending, hodls, or advanced strategies? And this is really where we can start to create our compounding flywheel and build our portfolio over time without having to consistently dollar cost average. So I might take 50% of that $1,000 and put it right back in liquidity pools. This would be a good scenario if I want to make more income. But again, we are taking on more risk by putting just 50% in liquidity pools. And the reason why is because liquidity pools have divergence loss. A lot of the times in most scenarios, if my portfolio is weighted evenly, like we spoke about in the first video, I am going to put a lot of this capital into lending, into hodls, and then some into liquidity pools. A lot of the times if my portfolio is balanced, like we spoke about in the first video, I'm going to allocate this income towards hodls. So my strategy is typically to run something like Ethereum to syrup, something that I want to gain exposure to. I put a big buy-in at the very start of the strategy, something that I'm confident in, obviously. So in this instance, it was about 10 grand into Ethereum to syrup, about half is in Ethereum, half is in syrup. And then over time, I generate income. I take all of that income, no matter how much is in the Ethereum portion, and I sell it all into syrup. So I can build a bag of syrup over time. And then when I end up exiting this pool, I flip the capital into a new strategy and move on. And I also have some strategies, typically delta neutral strategies, where I'm taking that income and I'm putting that into liquidity pools. So that's going to make up for the LP allocation of my portfolio. Lending. Sometimes we can lend out assets. Again, this is probably going to be about 15%. Usually I'm only using lending If I'm doing big buys on assets, I take those big buys, put them on the lending and borrowing platforms. Or if I'm leveraging up, I take the borrow, typically put it back on the lending platform. And then HODLs are going to make up about 55% of my income, as I already spoke about. And then the other 10% will be in advanced strategies. This is typically delta neutral if I want to compound a little, pay down some divergence loss, stuff like that, basically. But ultimately, this is how we flywheel the growth of our portfolio. We use strategies just like this. We use the income to generate more income. We use the income to buy up more assets without having to take money from our wallet or bank account and put it into this industry, right? Now, on top of that, I still do dollar cost average. I still do make those occasional buys whenever the market is on a dip, basically. But using that combined with a flywheel system in my DeFi portfolio has completely transformed how fast I can grow my DeFi portfolio. If you guys enjoyed today's video, make sure to drop a like, subscribe, notifications turned on. I just want to give a quick recap of some things that you have to pay attention to after you enter a position, and that is, when should you rebalance? That's also, if your positions are still valid, you have to revalidate those positions, and of course, flywheeling your portfolio's growth so you can continuously generate more income. Guys, there's a video on screen right now that will break down my full DeFi formula strategy. I recommend you take a look at it. See you guys later. Peace out.